How to build a stochastic volatility model. Have you ever wondered how traders make sense of the wild swings in stock prices? One key to understanding these movements lies in building a stochastic volatility model. This model helps capture the unpredictable nature of market volatility, which is essential for options trading. Let's break down the steps to create this model in a straightforward way. First, you need to assume that the asset price, which we can call S at time t, follows a stochastic process. This is similar to geometric Brownian motion but with a twist. Instead of having a fixed volatility, the volatility itself changes randomly over time. This means we will model the variance, denoted as nu at time t, as a separate stochastic process. Next, we need to define how the variance behaves. This is done using a stochastic differential equation. The variance process usually has two main components, a drift term and a diffusion term. The drift term, which we can call alpha of nu, shows how variance tends to change on average. The diffusion term, beta of nu, captures the randomness in volatility changes, often referred to as the volatility of volatility. If both of these terms are zero, we revert to a simpler model where volatility is constant. Now let's talk about the key parameters you need to set. The initial variance, nu 0, is where you start your volatility level. The volatility of volatility, denoted as Xi, controls how much the volatility itself can change. Higher values of Xi mean more extreme price movements, which can increase the risk and price of options, especially for those that are out of the money. Another important parameter is the correlation, denoted as ρ, between the Brownian motions driving the asset price and the variance. A negative correlation is often seen in stock markets, meaning that when prices drop, volatility tends to rise. This relationship leads to the volatility skew we observe in option prices. Speaking of market features, the stochastic volatility model helps explain the volatility smile and skew that traders see. The volatility smile occurs because options that are far in or out of the money tend to have higher implied volatilities. This reflects the greater uncertainty surrounding those options. The skew, on the other hand, is a result of the negative correlation we discussed earlier, causing out of the money put options to have higher implied volatilities compared to call options. One popular example of a stochastic volatility model is the Heston model. In this model, the equations for asset price and variance are defined as follows. The change in asset price is equal to the expected return times the asset price plus the square root of the variance times the asset price times a Brownian motion. The change in variance is defined by a mean reverting process, where the variance reverts to a long-term mean, along with a term for the volatility of volatility. After setting up the model, the next step is calibration. This means adjusting the model parameters to fit real market data, particularly the prices of liquid options across various strikes and maturities. You can use numerical methods like Monte Carlo simulation or finite difference methods to price options under your stochastic volatility model. Finally, let's talk about practical applications. A stochastic volatility model allows for more accurate pricing of options, especially for those with varying strikes and maturities. It also aids in better risk management by capturing how volatility changes over time. This leads to improved hedging strategies that take into account both price and volatility risks. Building a stochastic volatility model is a powerful way to understand the dynamics of options trading. By modeling both the asset price and its variance as random processes, traders can better navigate the complexities of the market.